My name is Mark, and for the best tax planning strategies that you won't find on Main Street, subscribe to my YouTube channel and hit the notifications bell so I'll let you know when I post my new videos. Today, let me start with 3 questions. Is there somebody at the Internal Revenue Service that you are so madly in love with that you want to leave them a bunch of money when you die? Question 2, when you turn 65, it's a race. It's your money versus your life. Which one do you want to win? Question number 3, what if you are a doctor, an attorney, or small business owner earning $500,000 a year and you retire and you can't maintain your lifestyle because of the limited 401k contributions you had during your business time? I'd like to share some results of a survey done by Kravitz, over 300 companies over the past 20 years, about the biggest retirement mistakes that high-income business owners and professionals make. It covered highly profitable businesses of all types, medical groups, law firms, closely held businesses, family businesses, sole proprietorships, companies with older owners who are seeking how to accelerate their retirement, those who are seeking enhanced benefit packages for their employees, and even sole proprietors making more than $250,000 a year. Here are the biggest mistakes, starting with number 10. They had no idea that concepts like a cash balance plan could be added to an existing 401k or profit sharing plan in order to enhance retirement contributions. First, they relied on bad advice about 401k rules. And some also relied on uninformed colleagues or advisors who gave them this information. Number 9, in 15% of these companies, they left these retirement decisions up to HR executives. HR people typically view retirement plans as a commodity and therefore try to minimize costs instead of maximizing the retirement savings for the owners and the employees. In 17% of the companies studied, there was a penny-wise, pound-foolish mentality that just resisted spending money even if it was for a tax-efficient plan, even though it would deliver significant tax savings down the road. Number 7, in 18% of the companies, partners owners tried making their own investment decisions, and in most cases overestimated their ability to do this. This resulted in some major problems for them. Number 6, some business owners, in this case 26% of those surveyed, feared setting up any plan that would give more money to their employees. The good news is these fears can be overcome when owners see how concepts like cash balance plans can be leveraged for accelerated retirement savings, tax benefits, and employee retention. Number 5, in 29% of the companies surveyed, there was a miscalculation that it was better to have after-tax savings instead of taking advantage of before-tax savings. Some thought pre-tax savings were not as beneficial as after-tax savings and just decided to bite the bullet and pay the taxes up front. Now, most tax advisors recommend that everything should be funded on the before-tax side before other strategies are looked at. Number 4, in 31% of the companies surveyed, the owners believed in pouring the profits back into the company and keeping all the assets tied up into the business, period. In some cases, they felt this by far was going to be the way to earn the highest rate of return on their money. However, this is a vulnerable strategy when it comes to retirement, and it also doesn't protect assets from creditors in the event of a business failure. Number 3, some owners assumed advanced plans were too good to be true. In 35% of the companies surveyed, there was healthy skepticism about any type of advanced strategy being used. However, partners and owners over age 40 who had to play catch up with their retirement savings were very eager to learn about these age-dependent contributions. The fact is, the older you are, the more you can accelerate your retirement contributions in a cash balance plan. Number two, owners in 38% of the companies surveyed believed that the qualified plan limit for contributions was $18,500 in 2018. Let's face it, few people enjoy digging deep into IRS regulations. Most were shocked to learn that adding a cash balance plan to an already existing 401k and profit sharing plan could accelerate their retirement contributions by $50 to $100 to over $200,000 annually. And the number one problem discovered was business owners either started too late or didn't save enough for retirement. And this was found out in 49% of the companies reviewed. Many professionals and entrepreneurs neglect their retirement savings while they're building their company. Due to this, they needed to do some serious catching up on the retiring savings, basically trying to compress 20 years into 10 years or less. Wow. If you're in any one of these categories, don't feel bad. It's time to start getting the facts and start vetting options. So what do you do now? If saving hundreds of thousands of dollars additional for retirement, as well as slashing your tax bill significantly, is important to you now, click below to see if you qualify to work with my team of CPAs, tax and pension attorneys, charter financial consultants, and third-party administrators. And if you like this video, give me a thumbs up or subscribe to the channel and share this information with your fellow business partners, associates, and your friends. I'm here to help you turn forever taxed money into your never taxed money.